Welcome to today's explainer. Let's just jump right in. I want you to step into the shoes of a founder who literally just incorporated their company today. You've got no profit, no office, maybe you don't even have a single customer yet. It's really just you, a laptop, and a massive idea. But then, despite having absolutely zero revenue and maybe not even a finished product, an investor sits across the table from you and offers a check for $500,000. Just like that. Which immediately brings up a pretty crucial question, right? How in the world do they decide what your startup is actually worth? It's kind of a fascinating paradox when you think about it, raising millions of dollars with basically zero profits on the books. Well, today we're going to break down exactly how startup valuation works. So here's the roadmap for our explainer. 1. What is startup valuation? 2. Valuing the future. 3. The simple math. 4. Why valuation matters. And finally, 5. Increasing value. All right, let's get into it. Section 1, what is startup valuation? Estimating your company's worth. This right here is the foundation of literally every investment deal you'll ever read about. At its core, startup valuation is just estimating how much the company would be worth if it were sold today. So if a startup is valued at $1 million and an investor puts in $100,000, they get 10% ownership. It's really that simple. Without this baseline number, there's just no deal. Moving right along to Section 2, valuing the future, the paradigm shift. Now, there is a massive contrast between traditional business models and the startup world. Think about it. If you buy a local bakery, you're going to value it based on last year's sales, right? But startups usually aren't profitable yet. So instead of looking backward at history, investors look forward. They look at the market size, the team, and the overall growth potential. Imagine a startup building electric cars in a trillion-dollar market. They might command a massive valuation before they even sell a single vehicle. Investors aren't buying the current reality, which, let's be honest, might just be a blueprint on a desk. They are buying the future monopoly. Okay, Section 3, the simple math. Breaking down the mechanics, let's anchor these concepts with some clean, round numbers. Imagine a founder is raising $200,000. If the investor believes the startup is worth $800,000 before the check is even written, well, that is your pre-money valuation. You just add the $200,000 investment to that, and your post-money valuation becomes exactly $1 million. And that new $1 million pie is then sliced up. Because the investor contributed $200,000, they own 20% of the pie. The founder retains the other 80%. The math itself is straightforward, but man, the downstream effects of this are massive. Which brings us to Section 4, why valuation matters. The stakes. This is exactly why founders negotiate these numbers so fiercely. It is a really delicate balance. Set the valuation too high, and investors might just scoff and walk away entirely. But set it too low, and founders end up giving away way too much equity for the capital they need. You see, it's not just about today's bank balance. It's about control and long-term leverage. Let's look at how a miscalculation plays out over time. If your early valuation is so low that you literally have to sell 50% of the company just to survive, you're in trouble. You might work tirelessly for years to turn it into a massive enterprise, but when you finally reach the finish line, you only own half of your life's work. Early equity is, without a doubt, the most expensive thing a founder can ever give away. So, Section 5, increasing your startup's value, drivers of worth. If you are that founder, how do you actually drive up the premium on your startup? Well, investors will pay a premium for specific de-risking traits. They're looking for an experienced founding team tackling a massive market with defensible tech. You add fast growth and loyal customers to that mix, and boom, the valuation climbs. This is exactly why startups obsess over growth metrics, because growth proves the underlying value. But here's the kicker. You can have two startups with the exact same revenue, yet they might have wildly different valuations. Why? It really comes down to three intangibles: vision, potential, and timing. The startup game is won by proving your vision aligns perfectly with the right timing to capture massive potential. So, if there is one ultimate takeaway you get from our explainer today, it's this. Investors are buying the future, not the present. Valuation isn't always about current profits. Actually, scratch that. It's almost never about current profits for a startup. It is entirely about possibility. You are selling the upside. Valuation dictates ownership and maps out the future control of a company. But it leaves us with one final, kind of provocative question. Once the math is done and the money actually hits the bank, What happens next? How do startups deploy that cash to actually achieve the massive growth they promised? Think about that as we wrap up. Thanks so much for joining me for this explainer, and I'll catch you next time.